Hi everyone, this is my channel, the DIY Investing Guy. I'm Callum. Obviously I was going to be doing a free trade portfolio update this week, started from scratch. I've started a brand new free trade portfolio, but I haven't quite got all my initial positions done yet. I've still got a bit more money to invest into them, so I thought I'd start this week by doing a portfolio update of my ISAs, both my stocks and shares ISA and my lifetime ISA. I'll probably be trying to do a monthly update on these. Every month I'll give you an update through YouTube, but I do a weekly update on my Instagram page, which is at the DIY Investing Guy. Links in the about section of this YouTube channel. Could I just ask you before I get started, if you enjoy portfolio updates and investing and stock markets and stuff like that, could you please subscribe to the channel to help the channel grow? Give a thumbs up to this video just to help with getting it out to people that might enjoy investing and the stock market and long-term investing, really. I'm going to go through, this is more of a preview and a review of the portfolio, because I've had this portfolio for a couple of years now, and I'm just going to go through how I've invested in the past and how I'm investing going forward in this portfolio and what my aims are of this portfolio. So I'm just going to get straight stuck in, really. I opened my lifetime ISA in December 2018, and I opened my stocks and shares ISA last March in 2020, and I've done this through the brokerage Hargreaves Lansdown. I enjoy this. It's great. Got great features, like you've got your news, search up any investments you want to. It gives you live market, you know, it's pretty spot on to the point for its real-time market prices. You can put your watch lists in there. I've got funds there at the moment, and then obviously you can open your account. You got your accounts. I'm just going to go through the current performance of these portfolios. Let me just get them up. Right, so since I've started investing in my lifetime ISA, my stocks and shares ISA, the total I've invested into these is £13,800. I've also had £3,000 lifetime ISA bonuses. With a lifetime ISA, you can put £4,000 in a year and get 25% top up from the government. So I've maxed it out for the last 3 years and got a full £1,000 lifetime ISA bonus from the government every year, £1,000 deposited into the account. So combined, that's a total of £16,800 invested into my lifetime ISAs. Alexa off. Sorry about that. And then the capital gain that I've accrued over these past two and a bit years is £6,465.36, which is a compounded rate of return of 38.48%. A lot of that was due to last year. I was pretty much all in cash, and by luck, more than market timing, the market crashed in March due to obviously COVID-19 and things like that. And I was able to invest in quite a few blue chip stocks, blue chip companies at you know, really depressed prices, and I'll go through a few of them in a minute. The current performance on my unliquidated assets, unliquidated assets, meaning assets I haven't sold, is £752.23 at 4.9%. And obviously the last trading day, you can see it was a daily gain of £128.22, which I'm quite happy with that performance. And I'm just going to go through what stocks did well for me last year in the portfolio. I've sold all my single holdings in my ISAs now, so that's what I'm using the free trade for, is to build positions in companies that I'm researching and interested in. The first company that my three biggest performance last year was a company called Distill, which is a drinks manufacturer. It makes red leg rum, which it's most famous for, but it's only a small cap company. It's only in the millions of pounds. It was actually a penny stock. It's listed on the FTSE AIM index. which is for smaller companies. And I managed to get a £2,190 gain on this at 91.97%, which was basically 100%, my first 100% stock, and I was really happy with that. My second was Legal & General, which is a UK insurance company. It's well known around the world, and it paid a good dividend, which, you know, I wasn't really investing for dividend because I'm mainly using these portfolios for growth. And I had a gain on that of £1,520.72 at 58%, which I was also happy with that. But obviously the prices were so low last year. If you brought into them, you got a good return on your money over the year. And finally was Greggs, which is a high street bakery, food on the go outlet in the UK. Does hot pasties, sausage rolls, baguettes, meal deals, sweets like donuts and croissants and stuff like that. And I had a gain of £1,581 on that, 39.1%. So those were my three top performers. But I also had other notable holdings in JD, Boohoo, which I made quite a decent amount on. I just didn't invest as much money into them. And obviously I was limited to the amount of capital I had last year. I only started with about £6,000 capital last year, so I wish I'd had more. But in hindsight, we all wish we had more capital to invest when prices are cheap and stocks are on sale. I have taken a different route to my main portfolios now. I'm trying for a different strategy because I could have swings of £1,000 a day on my portfolio with single stocks, and it was quite concentrated. The portfolio, I only had like 4 or 5 different holdings in a £20,000 portfolio, and I didn't feel comfortable with that level of diversification. I'm not Warren Buffett. I'm just an everyday guy learning how to invest, doing it myself, DIYing it. So I decided that I was going to take a different approach, and I was going to build my portfolio now that I had more capital to spend. So I crystallised my gains on all my individual holdings. And I was quite happy, you know, with the prices that I sold out at. Some of them have gone on to do more, and you know, it's always the way. Normally when I buy into a stock, it goes down. When I sell out of it, it goes up. It's just my luck, that is. But I thought I'd take a more different approach to this and try and build a portfolio, a long-term portfolio. I'm only 30 years old, so I'm going for growth, you know. I've got a 30-year time horizon. So, but I thought I'd try a bit of fund investing and investment trust investing. So I'm going for a core satellite strategy. The only fund I invested in last year was Fundsmith, so that's my biggest holding at the moment. I'll just go into my Lifetime ISA, which, you know, it's got them, and that's why it's my biggest holding at the moment. Is Fundsmith equity, and obviously I dollar cost averaged into that over the course of 2020. It's top 10 holdings. It's a very concentrated portfolio with only about 25 stocks in there, but it's, you know, it's got great household names, great companies: Microsoft, PayPal, Facebook, Index Laboratories, Novo Nordisk, Philip Morris International, Intuit, Estee Lauder, McCormick & Co, and L'Oreal. So all well-known companies. It's got a great, it's a global equity fund, which is, you know, most of it is in the United States. Let's have a look at overview. You know, its 5-year record is pretty good, so I've got a decent holding in that. It's actually my biggest holding at the moment. But obviously the plan is to get this S&P 500 index to my big holding. So I put £1,000 in this every quarter, and I also put dollar cost average £100 a month into it, as I want this to be the core of my portfolio, with all the other funds and holdings as the satellites off the core. So that's the plan for that. Artemis, all the other funds are just dollar cost average £100 a month into, we'll try there and thereabouts. Artemis Income is great, UK income fund, and I'll have a look at the top 10s in this. As you can see, it's very much, you got your Tesco's, your Legal & General's, high dividend payers with good growth prospect, you know, growing their cash every year. And then he's got a good fund manager on this, and he's very experienced in UK income, and he invests in companies that can generate enough cash to pay out the dividends, so the dividend's covered basically. So that's good. So I've got that in there. I've got quite a few UK. I mainly got my main portfolio. I'll talk about the asset allocation is generally to North America. But I have tried to increase some of my UK holdings, purely because I think the UK is an unloved sector of the stock market, and I think it's got plenty of future growth in the next 10 years. I'm holding Jupiter Asian Income, Bale and Gifford, Lindsell Train UK, Lindsell Train Global Equity, which I won't be adding any more to these. And then I've got 2 investment trusts, Scottish Morgan Investment, which is a great investment trust. It's very similar to Cathie Wood's ARK Investment. It invests in your Teslas, and it was one of the first investors of it, big investors of Tesla when it wasn't a very popular stock. It was constantly being shorted. It wasn't very loved. It was, it wasn't a great stock when they invested in it, but they saw the potential for growth. They obviously invested in Illuminum, Delivery Hero, all up and coming companies, and they have a lot of private companies in the investment trust, which is, they can invest in an investment trust into private equities. So that's why I've got that in there. Let's just have a look at that. Actually, its top 10s are Tencent, Chinese, Illumina, Amazon, Tesla, Neo, which is like the Chinese Tesla, Alibaba, the Chinese Amazon, Meituan, ASM Holdings, Moderna, and obviously they've made their own vaccine recently, haven't they? And Delivery Hero. And there you can see it's got technology, communication, consumer cyclical, 40% healthcare, and it's got 22% for China, 36.6% United States, and then obviously a lot of European countries and whatnot. So that's my investment trust. I'm trying to keep the investment trust to about 5% of my portfolio, so I've given an initial 5%. And that's what it is. I love Scottish Mortgage Trust. I'll just go back to it now. It's not a high dividend, but it's a high growth. As you can see, the returns over the last 5 years are phenomenal. The last year is nearly 100% up. And its average premium discount, it's normally running at a premium discount of 0.8% up, 0.18% up. I brought in when it was 3% premium discount down on the actual NAT asset value. So I brought about 3.5% down. And obviously in the last couple of weeks it's recovered. So that was my buy. That's where I thought my buying point was. And I thought I'd apply a 5% rule to these, because I don't want to be too highly invested in too many, I'm trying to keep my portfolio balanced. That's what I'm trying to do. And then finally, Finsbury Income and Growth, which is run by the Lindsell Train UK. The Lindsell Train people, they're the fund managers of this income trust, Finsbury Growth and Income. So that's why I won't be investing any more in them, because I've put a 5% in the Finsbury Income Growth. I do prefer income trusts now than I do the actual funds, and I found these funds to be pretty good because you cheaper fees basically. But they are more volatile. But over long term, you're looking at better returns, I think. But I'm keeping it to 5% because of the volatility and stuff. So I won't be investing anymore in the Lindsell Train, but I'll keep my holding because I'm quite happy with the amount of, the position I've got in the UK stocks at the moment, which I've increased over the last couple of weeks because I think there's plenty of opportunity for growth. And these are my holdings at the moment. They've got 7 funds and 2 income trusts. Let's see. My top performing fund is obviously Fundsmith with £379.94 gain, which is a 12.08%. It's not done the best it's done well over the last week. It's not done the best over the last couple of months, but because it's my longest holding, I got in at cheaper prices last year. That's why it's got the biggest gain. This last week, last couple of weeks, it's been Scottish Mortgage. Has been my best performing fund. I've only held it for 2 weeks and I'm already on an 8% gain. So even though it's a trust, it's sort of structured like a stock. So they're my single holdings, my trusts are. So 8% gain in 2 weeks isn't bad. But I'm just looking for that as a long-term hold. So if it goes up and goes down, in the next course of the year, if I've got more capital to deploy and it goes under 5%, I'll be investing more money if it's at a decent valuation. What I think's a good price to buy, but I'm not looking to sell any of my holdings as of at the moment. I'm looking to hold and not interrupt any of the compound growth. And I'm happy with my holdings. Obviously, last week I brought Finsbury Growth and Income. I brought 125 shares of this at £8.63 a share, which total cost of just about 1,100, and I'm currently on a 22.79 increase, 2% in the week, which I'm happy with, but it could go down. I don't mind it going down a bit because, you know, next year I might be able to buy more. I think these are great trusts for the long term, and it pays just under a 2% dividend. All my funds are accumulation except for global, because obviously the dividends are reinvested into the fund, and the fund price goes up over the long term compared to the income where it's paid into your account. The only reason I've got an income on global equity is because there's no option for me to get an accumulation on this platform. If I go through my asset allocation, I am 34% of my asset allocation is geared towards North America. UK equities is 18%. It was 14%. It's nearly 19%, 18.8% now. So obviously, I've spoke about that. I feel like the UK equities has room for more growth over the next 10 years or so. Asian equities, as obviously I see this as a growing consumer market. I've got a 9.4%, and I'll just go through this fund actually, Jupiter Asian Income. This is my main one. It does pay like a 3% dividend. Its top 10s, there's nothing to show on there at the moment, it's not playing up, is Samsung Electronics, Taiwan Semiconductor, Media, Hanhai Prison Industry, Macquarie Group, I can't pronounce all of these. The interesting one is Ping An Insurance, which is for, like, you know, consumer insurance like us, and that's a growing sector in China as more people are becoming working class and they want to get insurance for stuff. So Ping An's a good one there. All the big name Tencent's in there. It's mainly geared to technology, but it does pay a good dividend, and it you know, it's been a good performance. It's only been around for 3 years, this is, but the manager is experienced in Asian equities and income equities in those countries. Last year was phenomenal, 40%, but he's got a good track record over the last, you know, as long as he's been around for, which is it's quite a good track record. So I'm happy to hold this. It's also the Wealth 50, Hargreaves Lansdown Wealth 50 of funds. So that's why I'm holding that one. UK equities 6.3%. I'm not trying to, it's just basically percentages of the funds, because I'm not looking to increase in my European equities, because it's a bit volatile in the European markets at the moment, and I'm not 100% sure there's a lot of growth in these markets. You know, it could get worse before it gets better. And my cash equivalent is about 31%. I always like to have a bit of cash on hand, just in case there's any opportunities to buy the dip, or, you know, get things when the prices are cheaper. But I do deposit money into my accounts every month, and I will be looking to dollar cost average over the course of 2021 and deploy my capital, especially when there's opportunities arise. I like to have a bit of cash to, you know, I'd rather go out with a bucket than a thimble, as Warren Buffett would say. I'm just going to go through my top underlying holdings of this fund. So that's basically all the top 10 stocks that are underlying in the fund, in the portfolio, obviously, because the funds all hold stocks, and the top 10 stocks that I'm holding as an X-ray analysis. Obviously the highest, sorry about this, the top, it's hard to talk fast all the time. The top fund is Scottish Mortgage Trust. So obviously that's my top holding because it's structured like a share, and that's 5.1% of the fund. I spoke earlier about only wanting 5%. My second top holding is Finsbury Growth and Income, which is 4.8%, which is around about the 5% mark, which I'm happy with. Microsoft is 1.7%, PayPal 1.3%, Diageo, the drink company, 1.3%, Unilever makes everything from pop noodles to bleach, and Lynx, everybody has Lynx at Christmas, don't they, is 1.3%. The London Stock Exchange is 1.3%, Amazon 1%, Facebook 1%, and Intuit 0.9%. Those are my top 10 holdings. As you can see, most of my holdings are in the blue at the moment, which I'm really, really happy with. They've been a sea of red for the last couple of months, to be fair, because I've only just started the portfolio with the core satellite approach in the last couple of months, and it's going well. Most of my gains have been from this week, to be fair. It's gone up and down, but I've just tried to average down into you know, things that I think are high growth and, you know, we're getting them at a good price, I brought into the dip and just deployed some capital when the prices were lower. Now I'm happy just to hold them as it is. So that's my lifetime ISA, 769% with 5.33% increase in this ISA. And obviously it's the start of a new tax year this month, April the 6th. So I've just deposited. I try and deposit around about £300 a month to get the £4,000 in over the course of 2021. So I'm £300 in at the moment towards the £3,700 annual allowance on a lifetime ISA. Then there's my stocks and shares ISA quickly, which I'm only invested in Bayer Gifford, the same company that runs the Scottish Mortgage Investment Trust, but this is more of it's just a North American equity fund, but it's got tech stocks in there. Like, was one of its biggest holdings was Tesla. Let's just a quick look at the top 10 holdings, and now it's Shopify, which is Canadian, which is it's only, I think, yeah, if we look down at it, it's 90% United States, 1% cash, 7% Canadian, which is all Shopify. So, and the second's trade desk: Amazon, Wayfair, Roku, Tesla, Twiolu, Netflix, Zoom, Moderna. It looks basically like the ARK investment, one of the ARK investment funds, doesn't it? And you know, its returns over the last 5 years are phenomenal. Also, last year was 120%, but even as on a consistent basis, it's a great returns. And that's currently gone through a dip, so I've got that in both my portfolios, but I'm only holding, this is the only fund I'm holding in my stocks and shares ISA at the moment. I'm just trying to dollar cost £100 a month into that. Yeah, so because I'm going for growth at the moment, obviously I've got a long time horizon. I'm not looking for dividend income. As this portfolio grows, I will look to invest in different funds and maybe individual stocks. That I might move over from my free trade portfolio at the end of the financial year, just to, you know, for tax advantages and stuff like that, better nicer some of my holdings, and obviously lost harvest some of my poorer stock picks. And that's it really. Obviously, current loss on this is 17.64% on unliquidated assets, with a just 2% down. So it's not really done anything, to be fair. But I have averaged down in the Bayer Gifford American fund while it was on a dip, but it's currently going. It went back up last week a bit, so that's why it is where it is. Yeah, that's basically my stocks and my ISA portfolio, my stocks and shares, and my lifetime ISA portfolios. I hope you've enjoyed this video. It's not really the free trade one, but I'm going to try and do this video every month, because this is where the bulk of my money is going to go towards my financial future and financial freedom. I'm just going to ask you if you could please subscribe to the video, put a thumbs up for a like just to help it, and then it's a growing channel. I've only got 14 subscribers. That's why I'm not doing weekly videos on my ISA portfolio updates, because it's not paying the bills, YouTube. I'm just doing this for a bit of fun, and I hope you all enjoyed the video, and I hope to see you. I hope you subscribe and hit the notification for future videos. Have a nice day.